If you've ever wondered why many Forex brokers don't accept US clients, you're not alone. The world of Forex trading is vast and diverse, but for US traders, finding a broker can be a bit more challenging. The primary reason boils down to the stringent regulatory environment in the United States, governed by the Commodity Futures Trading Commission, CFTC, and the National Futures Association, NFA. By the way, if you are looking for a reliable broker with very low deposit requirements and quick withdrawals, see the links in the description box below. Firstly, let's talk about compliance. U.S. regulations impose higher capital requirements and demand regular, detailed reporting from brokers. This isn't just a minor inconvenience. It requires significant investment in legal, accounting, and compliance infrastructure. For many brokers, especially smaller or foreign ones, the cost of meeting these requirements simply outweighs the potential benefits of serving the U.S. market. Another crucial factor is leverage. U.S. regulations limit the leverage brokers can offer to retail traders, capping it at 51 for major currency pairs and 21 for minor pairs. While these limits are designed to protect traders from excessive risk, they also make the U.S. market less attractive compared to other regions where higher leverage is permitted. This means that some brokers prefer to operate in markets where they can offer more competitive terms. Client protection rules are also a big part of the equation. U.S. regulations mandate strict standards for client fund protection, including the segregation of client funds. These rules ensure that traders' money is safe, but they also add another layer of complexity and cost for brokers. Ensuring compliance with these standards requires robust systems and controls, which not all brokers are equipped to manage. Marketing restrictions further complicate matters. In the US, brokers face stringent rules about how they can advertise their services. They must be careful about the claims they make and the methods they use to attract clients. These restrictions can make it less appealing for brokers to target the US market, as it limits their ability to reach potential customers effectively. Lastly, there's the risk of legal action. Operating in the US exposes brokers to potential lawsuits from clients, which can be both costly and damaging to their reputation. For many brokers, the legal risks associated with serving US clients are simply too high. In summary, while the US market is significant, the combination of high compliance costs, leverage restrictions, client protection rules, marketing limitations, and legal risks make it less attractive for many Forex brokers. This is why some brokers choose to focus on markets with less stringent regulations and lower operational costs, leaving US traders with fewer options.